Hi, I'm Andrew Savickas, publisher at yieldtalk.com, and today I'll be talking with Artem Milinchuk, the founder and CEO at the alternative investment platform FarmTogether. Artem has more than a decade of experience in food, agriculture, and farmland, including time spent as CFO and VP of operations at Full Harvest Technologies, along with time at Ernst & Young and PwC. Artem also holds an MBA from the Wharton School. Artem, thank you so much for joining me today.
Andrew, thank you for having me.
Well, and it's beautiful weather there, it looks like. You're in Los Angeles, is that right?
That's right, yeah.
Oh, very nice, very nice. So, Artem, there's a lot of options out there for investors looking online for alternatives. I mean, we've got more than 120 in our database of investment platforms. Why should investors consider farmland as part of their alternative portfolio?
Yeah, absolutely. So what I really like about farmland and what I always loved about farmland as a individual investor, as a professional investor, is that it just checks a lot of the boxes you look for when you're looking to compose a long-term diversified portfolio. And I use that intentionally because I think that investing isn't about buying something or investing in something. It's actually about achieving your financial goals, your short-term and long-term financial goals. And I think all the financial literature experience has shown us, even last few months, is that a well-diversified long-term portfolio is one of the best way to achieve those financial goals from an investment perspective. And so when we look at that, then farmland, first of all, has demonstrated historically, and we believe will continue to do so, really attractive return profile. From 1970 to 2018, farmland has returned more than 12% annually as a composition of both price appreciation and current income. If we look at the last 2-3 decades, it's been very similar to about 10.5%. Now, secondly, when we look at risk, which is how volatile is your return, what is the also probability of you losing all your money? Volatility is a financial term. Really, how we think about it is like, am I going to lose money? If we look at it from that perspective, then farmland has remarkable low risk. It's about 7% of management volatility, and the capital preservation aspect is very strong because you have a real asset. It's hard to really screw it up. You have crop insurance as well. So because of how also fundamental it is to our very lives, right? I mean, it's food and water, what we need first, then it's shelter, then it's, Zoom and AirPods and everything else. And so farmland just has that tremendous capital preservation characteristic. And so we think it's attractive on a risk-adjusted basis. Again, if we use more formal terms, Sharpe ratio, return divided by volatility, right. Farmland is about 1.7, which is actually better than almost any other asset class out there.
Wow.
So moving on to kind of more fancy things about portfolio construction, correlation. So ideally, you want something that is not correlated. Historically, real estate was one of those things. Unfortunately, COVID has shown that even that is not the case. And it also has shown us that we don't know the future, right? Who could have predicted COVID, right? If you ask someone 6 months ago, 9 months ago, and you say, what is a safe investment? They'll say, New York apartment. Well, now everyone's leaving New York in hordes, right? Office space, you think, we used to have AAA office space, so A grade, that's all gone now. And who knows when it's coming back. So diversification is important. And farmland from that perspective has negative correlation to low correlation to most other asset classes. It moves in its own way. Last 2 recessions, this one and last one. In the last one, farmland was up 23% in financial crisis of 08-09. In Q1 2020, farmland was down minus 0.5%, which is almost nothing compared to everything else. So, I talked a little bit about that. And then lastly, and then I'll pause here because I can talk about why farmland forever. Very good inflation protection. I think we're seeing increasing interest in that aspect of this asset class. We have clients who are worried about this monetary spending, monetary printing in US and globally. We're seeing interest rates at truly historic lows. The treasury inflation protected bonds are, I think, negative territory right now, if I'm not mistaken. People want inflation protection. And so farmland, farmland products go into thousands of consumer products. It's food, feed, fiber, fuel. It's also things like penicillin are made from corn derivatives and corn and soybean products. So farmland almost mechanically moves with inflation. And in a positive way, of course.
Right.
Which is why farmland in the last few periods of high inflation outperformed the S&P 500 by almost actually 30%, and has done quite well. So definitely something to also consider in terms of that capital preservation in real terms, not just nominal terms.
Okay. Thank you. And so let's say someone does. Okay, so you've presented a compelling case, and someone doesn't want to try investing in farmland. How does your company FarmTogether compare to other ways people can invest in farmland? And how do you compare with similar platforms also offering farmland investments?
Absolutely. So just to give a bit of context first, the farmland market in the US is 2.5 trillion. That is the value of farmland, and it's continuously growing. Less than 2% of that is currently owned by any kind of investor. We're talking institutional, we're talking sort of formalized stocks, mutual funds, private equity funds, what have you. So it's really a 2%. 98% is owned by families, farmer families, 60%, meaning you own and operate your farm, and 40% non-operated, but non-operated families, but it's all individuals. And of course, when you're non-operator, you own the land, you rent it out, so you could be considered technically an investor. But it's more like if you heard your neighbors selling their house and you happen to buy it, it's the people that are kind of informal economy, informal investment market. It's not that they invest into any sort of structured way if you would go and open an account with Fidelity. And so for most people, it's really hard because you need to know how to source farmland, how to manage farmland, how to buy the farmland at the right price, all those little things, all these little nuances. And so the way FarmTogether works is that we offer individual properties to accredited investors, and you can start building your portfolio. So we describe how the deal works, we describe the risk, we describe the return profile. It's all very easy to see. We do webinars, there's videos, interviews with the farmers to really just give you all the aspects of what you're investing in, educating you on that so you can make a good investment decision, but in a very clean, very simple way, because there's a lot of complexities there, so we try to simplify it. Now, to answer your question, Andrew, kind of what are other alternatives out there to invest in farmland? Look, I would say that there's one is there's just not enough, right? So always happy to hear when there's something else comes out, someone else starts doing this. But to kind of maybe walk through the history of farmland investing, and that I also will then explain what exist. Like the big players, Nuveen, US, they've been around for a while, and it's big institutional funds. So if you have 100 million, you can go and invest in one of those funds. So probably,
don't we all?
Yeah, don't we all? Yes. Problem solved. But look, part of the reason I started FarmTogether is because I wanted to invest personally. I wanted to invest my mom's retirement money, my grandparents. And they always ask, like, would you put your grandma's money into this? Like, yes, and I do. And so unfortunately, my grandma doesn't have 100 million. I don't come from that background. And for most people, so that is inaccessible. So going a step down, you have smaller private funds, and quite a few of them have emerged. Typically, they have 50 to 100 million, a bit more under management. If you have 5 million, you can invest in them. So again, no, we don't have that money. So let me just kind of cut to the chase. Really, for the most retail investors, up to maybe 2-3 years ago, there was only 2 public stocks that were traded: Gladstone and Farmland Partners. Liquid, diversified. Because of the scarcity of farmland offering, my personal view is that there's a lot of demand for what is a limited supply. They also play in kind of certain markets. You don't have the choice which farm you can buy. Sometimes they'll put on debt that you don't want, but the company takes it on debt level. Public company fees can be substantial. And because they're big, they're now chasing after bigger opportunities. And we'll talk about that in a second, that typically are more competitive. So kind of hard to you can get those sort of farmland type returns, but I think we can do better with FarmTogether. But having said that, look, I have nothing but respect for those companies. They blazed and are blazing the trail for farmland investing. They're key members of the institutional index in farmland. And so we learn from them, and definitely wishing them all the best. So no, like I said, it's such a blue ocean market that really competition doesn't really define our business. But and there's definitely a few other platforms. Yeah. Sorry, Andrew, go ahead.
No, go ahead.
Yeah, and there's definitely a few other platforms out there. Look, I think kind of our modus operandi is we talk about us and just share what we think.
Mm-hmm.
We provide compelling investment opportunities. I don't really want to talk about, other sort of comparable platforms. People can do their due diligence, and you go from there.
Okay, fair enough. And if you do want to check it out, yieldtalk.com, you can find, 120 different investment platforms. People hopefully can
There you
do
go.
their
Yeah,
research there.
yieldtalk.com. That's
Yeah,
the best place to go. You've
that's right.
probably done it better than I have.
So how does an actual investment work on FarmTogether? So like, what is the investor actually investing in? What do they get?
Yeah, absolutely. So it's very simple and in a lot of ways similar to real estate investments. Um, Farmland is in a lot of ways like real estate, but it also is not. So just to maybe first explain how farmland investing works in general. What are you even buying, right? Are you
Mm-hmm.
buying a stock, a bond? Are you investing in a startup? Are you buying a cryptocurrency? What you're investing in is you're buying a piece of land.
Mm-hmm.
You buy it through a single property Delaware LLC together with other unit holders in that LLC. That Delaware LLC owns the title to that one piece of land. So it's very much separated from FarmTogether, so that even if you all get hit by a bus, it's still there. It's still managed according to the contract. It still is administrated by a third party called Assure that we work with, that does all the payouts, all the tax documents, all the Q&A. So it's kind of a way to truly give you as much as possible that direct ownership of the land. And we provide the management part. So how does this land actually make money? Well, there's several ways. It can be rented out to a farmer on a what's called a cash lease basis. So literally the farmer will pay you upfront every year.
Mm-hmm.
And it's a very vibrant market. There's typically 10, 15 farmers lining up. Because they pay upfront for only a year, there's zero default because you get your money upfront. And what's also great is that there's almost zero vacancy risk because there's so much demand for the land in that there's always someone looking to rent. Now they might pay a little bit lower if there's less demand, but they'll always rent because it's the biggest expense of the farmer. It's their productive asset. And typically farmers can actually spread their capital base, their labor force, their knowledge over more acres if they rent. So if you think about it, you have your tractor and you can, if you rent more land, well, you are kind of making money from more acres, and farmers keep the crop and they keep the profit. So you're just getting a cash rent. And that's kind of very simple. Like you bought a house and rented it out, right? Andrew, I don't know if you own or rent. I rent. And so,
Sure.
The next step there, a more complex one, is rental plus a revenue share. So you also participate in the harvest of the property.
Oh, okay.
Next, you have a profit share. So it means you participate in the profit. And then the next one is direct operated, meaning that you actually contracted typically to like a farming company or farming family, and their business isn't to take risk on the crops, on the price, on the harvest, but to actually be an operator. So you can think of it, I guess, trying to come up with an analogy, but they get paid and they're good at farming according to best practices. They're really good farmers, but they said, look, I just don't want to be exposed to the volatility of the crop. I want to do a great job tending to the trees, but kind of what nature yields, like the hand that nature yields you deal with that. And so depending on that level of risk, you have different types of returns. And of course, the more complexity, the more exposure to crop prices, the higher the returns, but the higher the volatility. And so the typical returns in the space are anywhere between 7 to 12, 13% total annualized.
Okay, that was actually be my next question about what kind of returns. And so I assume it varies then depending on which of those kind of offerings that you're investing in. Is that right?
That's right, Andrew. Yeah. So on the very conservative spectrum is what's called row crop farmland. This is your corn, your soybean. It's called row crops because you plant it in rows every year.
Okay.
And it's places like Illinois, Iowa, Nebraska. This is really the crop that, as I mentioned, it goes into feed, fuel, food. It's very important to remember that it's not just kind of your popcorn. There's a whole industry around it, and we're talking about complex supply chains that span the globe, based on U.S. corn that makes so many different products from it. So that's very important to note. So this land typically would be about 7-8%, maybe a little bit higher total returns. The returns are composed of about 3-4% cash yield, and the rest is price appreciation that typically is one we underwrite below the market price. We pass that on to the seller, so to the buyer, to the investor. So if we bought 10% below market, we'll pass it on to you. We won't, take 10% to ourselves. And then secondly, talking about farmland from a macro perspective, growing population, improving diets, decreasing supply of farmland due to urbanization, climate change, and not even limited, but like fixed supply, because they don't make land anymore, as they say. It's just causing land to slowly appreciate. And so there's that constant trickle up that historically actually has been very high. In the last 50 years, it's been 5.9%. We typically look at something like 3-4% when we look at that, maybe a bit higher depending on the property, but it's been quite compelling. So that would be your lower risk, and it's a cash rent plus revenue model. On the higher return side, you would look into more permanent crops. So we're talking like almonds, pistachios, walnuts. We'll be talking organic apples, citruses. Those typically will be either more profit share or direct operated. And the returns there can start from 9% and all the way up to 12 and sometimes even 13 and 15%. It's look, and the thing is, what I like about this returns though is that you're not going to make a buck. You're not going to quadruple your money and make 10x, 100x on, if you would, let's say, on Tesla or some cryptocurrency or startups. But again, what we love about this, you likely will also not lose your money because you're buying below market. We're underwriting conservatively. And so it's something that what we have found with a lot of our clients, especially more senior clients who are thinking about their retirement, is that they buy these farms and then they will essentially say, okay, what's the income I'm expecting? And I know what expense I'll have, and I just want to offset those expenses with that expected income. And so that predictability, I think, really matters as well to a lot of people, right? It's not just, returns are great, but like, I can't eat returns, I need cash.
Right. So there is that mix of, there's the ongoing cash from the rental payments, and in some cases, the revenue share on the crops. And then there's appreciation when the property is sold, presumably. What is the typical hold time for an investment like that?
So farmland really needs to be a long-term investment. Typically it's 8 to 10 years, but we are working on also a secondary liquidity market that will allow people to essentially trade units in the individual property between themselves. A pilot is going to be in September, and definitely look to developing it. I think there's nothing from a financial, legal, or business perspective preventing farmland to be more liquid than 10 years. And so it's just a matter of time and also getting critical mass of investors on the platform, which I'm confident we will.
Okay. So sounds like, not too different from a lot of other real estate investments where, 7, 8, 9, 10-year hold time, you have, whether it's quarterly or annual cash flow, and then you get appreciation on the resale.
Exactly.
So,
yeah.
And obviously the inflation protection sounds great, and limited supply is definitely attractive. At the same time, there have to be risks here with these investments. So what are the biggest risks that investors should be aware of before going into a farmland investment?
Yeah, so I would say with land, as with real estate, a lot of returns and risk lie in the price you purchase it at. So it's important to understand the pricing. What we do is that we do comparable analysis, and we also do a discounted cash flow analysis. Because sometimes the thing in farmland that's different from real estate, it's a very opaque market. Sometimes there is no market. Good farms, people just hold on to them for dear life, as they should. And so sometimes just you don't have enough of a market. So we also need to triangulate in other ways. And then the day will always come back to how much money is this going to make our investors? And so that's a risk, and you should look at comparable deals in the area if you can, or that discounted cash flow analysis that we also show. Secondly, as you can imagine, weather is a risk for farmland, and so there is adverse weather events. We insure our crops and trees, but that can, worst case scenarios can lead to, let's say, trees burning down, and then you have to replant, which loses you a few years. But again, the good thing is it's a real asset. There's a lot of value in the land, so it's only partially that you can lose, but that can happen. That's why diversification is important. Talking about weather on a longer term perspective, climate change. So what we do is that we look at long-term climate models and what it means for things like precipitation and temperatures. And when we look at land, we overlay that with the climate change models. Make sure that what we're growing here in 10 years will still be able to grow in 15. Especially because we are seeing clients and investments where people are actually asking us for a longer term period, the 10 years, 12, 15, 20, because it's such a nice cash flow that just happens every year. Land doesn't move, doesn't change. We eat almonds for 5,000 years. We're going to eat them for another 5,000 years. So that's walnut 7,000, according to some historical records. Anyway, coming back from the history lesson, water is important. So in a place like California, it's important to understand your water allocation now and in the future. And so that's something that we also look at as well. And then lastly, of course, it's definitely a commodity market, making sure that there's long-term positive trends in the commodity markets you're playing in. So almonds, for example, we do a little analysis looking how they are priced, how they're used. Walnuts, pistachios. Some other areas, for example, dairy is struggling and has been struggling for a while. So we're staying away from dairy because we don't have the confidence in that market long term. This prices right now, right? We're still going to drink milk, just. So I think that's really important. And lastly, in terms of major risks, Andrew, is operator. And so it's due diligencing the operator, making sure that they have long track record, they're established players, well known in their market, reputable. So doing that due diligence, that comes from having the relationships in the industry and building those relationships, honestly, over years now as well, getting to know each other better. So some of it is just, art of the trade, and you can't automate it. It's just truly building that relationship day by day.
Right. Well, I understand what you're saying about how, we've been eating almonds for 5,000 plus years, and we're going to eat almonds for at least another 10, right? But at the same time, there is clearly some changes in food consumption. It's widely assumed that Impossible Foods is going to IPO this year. Beyond Meat just did last year. There's this shift toward plant-based meats. You mentioned dairy is a little bit unpredictable right now. What are the implications of these shifts toward plant-based meats and other kind of dietary changes happening on farmland investing?
Yeah, absolutely. So the main trends we see right now, there's three of them. There's the plant-based protein, protein-based plant. Yeah, plant-based protein, a mouthful. And that's happening with other things like shrimps and fish. A friend of mine is doing like a plant-based salmon. So that's going to be a big trend. Yeah, wild type. Check them out. So there's that. And I think we're going to see that due to both ethical considerations, people and culturally in places that culturally are more vegetarian, like India, becoming more affluent, and so eating more because there's still a lot of hungry people in the world. 800 million people go hungry every year, which is horrible. So there's a lot of that. So you have that. That's trend number one, and we'll see that move from meat to plant-based. It's also cultural, ethical, and health. Those are the trends there, and climate, right? Animal-based proteins widely considered to be big emitters of the CO2 and others, methane. So that's one. And so the way we think about it that way is that we look at what are the products going into those beyond meat. So, for example, chickpeas becoming more attractive, lentils, like what constitutes that vegetable protein, playing in that space. So the second trend is organic. People want to eat healthier and tastier, honestly. I mean, I'm sure you and your listeners, Andrew, when you buy organic strawberries and that regular one tastes like water, the other one tastes like an actual strawberry.
Yeah.
Yeah, and there's still consistent shortage for many years now of organic food. That's why it's still so expensive. It's complicated to transition it. And so we're looking to work with farmers as well in transitioning to organic. It's only about 50-60 billion right now, I think, organic market, which is a drop in the bucket still. And so making it affordable to everyone will be very important. But at the same time, organic sometimes has half the yield of conventional. And so we're talking about value of land and supply of farmland. Suddenly, we need to grow 60% more food by 2050 to feed all the growing population. And then you cut the land by half if you want everyone to eat organic. Now you're suddenly looking at 120% increase. So that's a very big trend. And then lastly, something that FarmTogether is working on very actively is regenerative agriculture. So sometimes it can be confused with organic. Organic is focused, there's some overlaps, but regenerative is really focused on preserving the soil and enriching the soil using natural practices, so like no-till. And what it does is that it creates that rich soil layer, right? That every year just gets better, and what it leads to is tasty produce for sure, sustainable all across the value chain, preventing things like nitrogen runoff, depleting the soil, so you need to put in more and more fertilizer every year, all the emissions from that. And then actually from a profit perspective, regenerative longer term makes more sense because you're putting in less and less fertilizer, your land gets more fertile. So actually longer term increases the value of the land. So it's very much a business proposition as well. And then what's really cool about regenerative, I don't know if you or your listeners have seen that Indigo just raised another 250 million. This climate impact company focused on farmers. Regenerative agriculture has the potential to recapture carbon in the soil. And by doing that, it can earn carbon credits, but more importantly, fight climate change. So people think that regenerative agriculture can be one of the few carbon negative industries out there. So actually not just playing defense with climate, but offense, which is very exciting. And so a lot of work being done there by everyone from UN all the way down to kind of national associations in US to bring those standards to the market. So I think we'll see those three trends, plant-based protein, organic and regenerative agriculture, playing increasing role in how people invest in farmland.
And if someone's looking at investments on FarmTogether, can they see, information about, is this one, is this regenerative farming? Is this, for plant-based proteins? Is there that level of
Of
detail?
course, yeah.
Okay.
Of course, yeah. We tell everything, like sometimes even too much. People call us and say, "You guys are too detailed." We want it simpler. So yes, you'll be able to see that.
Okay. Now, on the sort of short-term horizon, I know, a lot of people are dealing with fallout of COVID-19, and you mentioned, New York apartments, for example, and real estate, commercial real estate, retail, hospitality. Are you seeing impacts, either positive or negative, of COVID-19 on farmland in general, and then also more specifically on your own business?
Yeah, so I would say, start with our own business. We have seen just a massive influx of investors looking for safety, looking to diversify, looking for inflation protection. So it's been, knock on wood, a really good time for us. On the farmland side, there's been a little bit of short-term dislocation in shipping, which caused accumulation of certain crops at ports, which led to price drops. So in Q1, as I mentioned, we saw probably one of only 3 quarters that was slightly negative, minus 0.5% in the performance of the farmland index since 1992. And Q2, it's up again 0.5%. So overall, haven't really seen that much of an impact, both on operations. Farming generally is typically socially distanced anyway. It's not like you're standing, holding hands as you collect, harvest strawberries. On sort of the business side, look, the interest rates have dropped, and so mortgages have come down, loans have come down. So that's really been helpful for purchasing of land and for financing operating lines of credit. So, and then honestly, look, we thought at some point we had some clients calling, looking for opportunities that would be maybe a bit more distressed, or sometimes you have some non-farmer owner who's playing the market, got a margin call, needs to sell the farm holding. We have seen few of that. I mean, the thing about farmland is that it's just incredibly resilient, and people, especially individuals, I mean, when they invest in that, when they own it, they hold on to it. Now, what's driving, just to make a point there, so people are not afraid that we're not going to have farmland. The big driver in the investing of farmland is that average age of farm is approaching 60. Kids are retiring, and so about 70% of farmland is expected to change hands in the next 20 years. There's going to be supply of farmland, but it's just something that is also low in debt. The debt leverage on farmland is only 15% versus real estate like 40-50%.
Oh, wow.
Debt to asset, right? Debt divided by debt to equity, only 15%, which is so low. Makes no sense because it's actually the interest rates are very low. But farmers are conservative people. When you hear about farmers' bankruptcies, there are actually only some like 700 bankruptcies a year, which is a drop in the bucket given there's almost 2 million farmers. It's really like any other industry probably has more bankruptcies. So overall, we haven't seen some sort of distressed sales. We haven't seen any particular like crash in the market. It's been steady as she goes, with some occasional pockets and opportunities here and there that are small, but nothing really has blown up at all. And that's because COVID is happening, restaurants may be closed, right? Still the same amount of people that still need to eat. That's what it always comes back to. So you still need that food, right? Whether you're home or at work.
Right. Reminds me of the toilet paper shortages. It's there's
Yeah,
still people still have to go to the bathroom whether you're at work
that's right. Yeah.
or at home.
Yeah, that's probably the 100% correlation to food consumption is toilet paper consumption.
That's a very good point.
Yeah.
So you mentioned that statistic, and I saw that in the investor materials about 70% of U.S. farmland is going to change hands in the next 20 years, and that's 1.8 trillion dollars worth.
Yeah, it's
And
a huge number.
this sense of you've got families, they've been in the family farms. The next generation is not particularly interested in staying in the farming business. So it sounds like a great opportunity, obviously, for investors potentially. But who's going to actually farm this land if there's all these families?
A lot of are retiring.
Yeah, exactly.
So Andrew, great question. And just there's two parts to it. So one is what I want to talk about is there's still a new generation of farmers that are either staying on the land or entering the farming that is business savvy and tech savvy. I mean, the farmers we work with, they're just stellar. I had some farmers call me the other day and they were just rattling off this tech names like, do you guys use Slack for this, Asana for that, Zoom for that, all those tech tools
Oh, wow.
to manage it? We're like, yeah, we do. So they've I hope no one thinks that, but farmers are very smart, very capable people that work in extremely tough environment. So the farmers that stay will be getting bigger, and they'll be partially getting bigger by renting more land, by adopting new tech, by working with more innovative financial providers of capital like FarmTogether. And they still will be farmers. And honestly, same as I think, was it Jim Rogers or Warren Buffett was saying, farming will be the new middle class job of the 21st century, like the new white collar job where you can sit in your office and farm. And so that's the farmers that we're working with and we're seeing. So there still will be a lot of farmers doing that, but the size of the farm or the amount of farms they're farming will increase. I think there's a lot to be said, and the current USDA administration is doing that for bringing broadband to small rural towns. It's a huge issue. We need that Starlink, we need broadband. Maybe COVID will help a little bit, people kind of moving back to where they used to be and bringing it with them. So we do need to help kind of the rural economy, and it's not just about farming, it's about preservation of our natural resources. It's about equity for people. So there's a lot that's intertwined in the health of the farming economy that goes beyond just farming, the rural economy in general. And I think the good thing about that is that no matter the administration, I think the U.S. farmer holds a very special place in our hearts, in everyone's hearts. And so there's a lot of political support always for the farmers. So hopefully we'll see that emerge as well to help, the farmers staying to operate, grow food for the country and the planet.
Okay. Just kind of talking a little more about FarmTogether itself as a platform. Now, right now, as you mentioned earlier, it's open only to accredited investors, right? So that's, broadly speaking, investors who make $200,000 a year or more or have $1 million in net worth. Now, do you have any plans to offer investments on FarmTogether to non-accredited investors as well?
Absolutely, yeah. That's part of our mission to democratize access to farmland. A kind of internal tagline mission we have is we want every American to own a piece of America. I think it's really important for people to understand where the food is grown, to be a stakeholder in the land and to understand the work of the farmer and the land. I think it'll be better for everyone if we have that. Initially kind of everyone was at farming, then we moved to the cities to bring a bit of that back, that connection. But it's complicated somewhat legally, and also from talking about putting my grandma's money into that investment. We just want to make sure that when we bring a offering to the market is open to everyone, that everything has been tested out, cross the T's, dot the I's. We just brought the astronauts back from the space station with SpaceX.
Right. Yeah.
And so there was a lot of testing before that. It's the same thing here. We just want to make sure that it's fully ready for someone who wants to put in at one point maybe like $50 and never think about it again. And so there's still a lot of work to be done. We hope to have at least a pilot in 2021. And there's also laws around it that are making it easier. Definitely excited. SEC has some language that they were working with. So it might be sooner than that, but very much absolutely want to bring that. Yeah, it's a great investment for long term. I mean, you have your child is born, put some money in farmland in 18 years, they go to college, or even like for their first house. It's just something that invest and forget. So definitely want to bring it to everyone.
Yeah, and you mentioned some of those changes the SEC is working on, presumably and intentionally to open up access to more people. At this point, would you be leaning toward regulation, crowdfunding Reg CF, or more on the Regulation A in terms of the framework that you think you'd offer under?
Probably Reg CF now, later Reg A plus.
Yep.
Yeah, there's also other platforms that offer this kind of crowdfunding as a service opportunity. The thing is, we try to keep our fees really low, and those guys oftentimes charge like an arm and a leg, and so maybe we'll see. But for now, it's in the works. It's in the works. There's also a way to potentially do what's called a 506B, where you can have 35 non-accredited investors in each deal. It's not thousands, but 35 is a start. But again, it's just we really hope, and it seems like it's going that way, that SEC simplifies those rules a little bit. It doesn't have it kind of a one size fits all criteria. One other thing that SEC is looking to change is what defines an accredited investor.
Yep.
If I'm talking to someone who is a lifelong farmer, wants to put in 1,000 in a farm in the area, like that person probably knows more about this deal than anyone else.
Yeah.
Like they should be the first one in because they understand the risks. But right now we cannot take them, so SEC might change that as well.
Yeah, I think that's a long overdue change. There's a lot of situations like that in different industries and different sectors. It was funny. I had a conversation very much like this one with Anthony Zhang, the founder of VinoVest, which is a wine investing platform, and he was talking about how
we should partner with them to maybe invest in some vineyards.
There you go. But he's talking about how he's founded a few companies and spent a lot of time with venture capitalists, and points out that a lot of the associates working at VC firms don't make enough money to qualify as accredited investors, but they spend their day evaluating venture investments, right?
Yes.
So it's a long overdue change from the SEC. So the intention is everyday investors. You want pretty much anyone who, that's your vision, anyone who can have a piece of America. In terms of who's interested right now and who's signing up, I'm sure there's no single profile, but are there some personas or categories of people that you see with interest and enthusiasm for investing in FarmTogether?
Yeah, and you're right, Andrew. There's no single persona, which is great because it really validated the belief I had that it really is investment for everyone. So we have, your usual suspects: tech executives, finance executives. You have your C-suite, quite a few retirees. A lot of them have some sort of connection to farmland. Sometimes they even ask to visit the farm. They might know the operator, so it's been really great because that's a huge validation when someone who's been in that business for decades invests with you. I mean, that's just incredible feeling. We do have some international investors, for example, Germans, where interest rates are even lower, I think, and so they're just looking to. I think right now, if you put money in a bank, I could be wrong, please don't quote me on this, but you almost have to pay 0.5% to keep your money in the bank or something like that. And so an interest rate is just insane. Looking to get that yield, that basic capital preservation at least. And then you have some registered investment advisors as well, putting their clients' once they're starting to look into this, and they're looking at this from much more professional perspective, looking at risk returns, like really asking a lot of questions about saying things like administration. I would say the age still skews kind of 50-60, but seeing more and more younger investors as well, especially from the stock market that has really rallied to diversify from that. So yeah, can't think of like this one person. It's just a snapshot of a lot of different parts of America.
Okay. And for those people who may have some experience with other kind of retail sectors, commercial real estate or multifamily investing, or even residential single family rental, what are some important things that people need to know about a farmland investment transaction that might be different from what they've seen before in a investment in a multifamily apartment building, for example?
Yeah. So I would say one is that with a lot of those buildings, you have depreciation and maintenance. And you have a little bit of that in farmland, but it's really kind of just land that grows your food, so you don't need to suddenly, repair windows, install something else, something got flooded. There's just much less maintenance there. You also don't have that technical and design and style obsolescence, right? If you look at buildings from 20 years ago, it's just not designed for how we live today. They don't look that. You don't have that in farms. Again, like we're still gonna need almonds. So there's that. You also don't have. You have a little bit of that, as I mentioned, location risk, weather, right, water, but we account for that, and so there's less risk versus some sort of trends changing in that particular area in real estate. So if in farmland, in real estate, it's location, location, location. In farmland, it might be just like location. Yeah. So just one, maybe 1.5. I would say then also in terms of that vacancy tenancy issues, there's very little of that risk in the last. So we have a partner that invests in raw crops. In the 10 years they've been doing now over 200 farms, they've never had a farmer not rent it out. You always have that happen in the space. So you have that. Sorry, Andrew, 1 second. Let me just.
That's okay.
So yeah, just continuing the theme of real estate. I think looking at things like cap rates, if you look at core term in real estate, when we look at farmland, it's remarkable still how high the cap rates are. Multifamily, A-class buildings, sometimes the cap rates, your listeners will know better, but they can be 2-3%. In farmland, oftentimes you're still getting 6, 7, 8% cap rates. Okay. And so I think a part of what's going to happen is that it's going to be a long-term compression of those cap rates, meaning land prices will go up. And that's because real estate is now fully a big institutional market. There's so much capital that everything is priced out, right? And so there's always a buyer for something. There's always some sort of flip, repair, that different use. Now office buildings are being transformed into housing, which is great. You don't have yet that level of capital attention in farmland. And so it still trades very much like this kind of funky standalone thing. But once institutional capital comes in, and they already are, I mean, it's going to become very quickly where a Japanese $1 trillion fund in a deficit is looking at this. And, we might not allow them to invest in US farmland, right? That's a whole separate discussion, but plenty of US pension funds even. And they'll look at this and say, I'm so underfunded. My firefighters, my police officers, they're not getting paid. I need to diversify from stock bonds. I need something that is real, stable, long-term farmland. And when they come in, I mean, it's going to be trickle, and then it's going to be a total flood. And then I think we'll see those prices compress. So it's, part of the reason I keep coming back to this blue ocean opportunity. It's still a nascent market in a lot of ways. And so you get to come in, not after institutional investors, like always the case, but before institutional investors.
Yeah, I was going to ask you about that. I know that's something I've heard from some other platforms that are offering alternatives is, they start offering to individuals, often with a similar mission of democratization. And that also involves some significant expense in customer acquisition to get individuals on board. And sometimes, it's easier to take the bigger checks from the institutional or the family offices. Yeah. I'm curious if you've started to get inquiries from institutional investors or family offices or hedge funds or other people coming.
Yeah, definitely have. And I think, it's really important to separate democratization institutions. Those institutions are, for example, Franklin Templeton Legg Mason, that is an investor in us. That's a $1.5 trillion, primarily mutual fund, primarily retail focused shop. And so what we'd love about them, what we want to bring to them is farmland products they can distribute to their investors, right? And so I think it's a false dichotomy that if you're working with, hedge fund or institution that you're not democratizing farmland. I think it's complete opposite.
Okay. Well, I've learned a ton today. I mean, I was born in Illinois and I grew up there, but I didn't know a lot about farmland, even though
great farmland in Illinois. Yeah, we just actually have a deal in northern Illinois. Excellent, high quality land, great soil, great operators, picturesque views. So
excellent. Yes, it's a great state. But I have one last question for you, and it's something I try to ask all of my guests, and that's what's your favorite book about money and investing, and why?
I would say it's Principles by Ray Dalio, the founder of Bridgewater Associates, because it transcends really investing and it's just lessons for life. And it's so kind of non-emotional about first principles. I mean, it's so simplistic, which always takes decades to get to. He
Right.
says, figure out what is true and what are you going to do about it, and that's it, right? That's kind of the key to life in a way. And so I love it because it's about everything, not just investing, and it's a very non-emotional approach. Because at the end of the day, we're an investment platform, and so we want to bring that thinking to how we do business. But yeah, strongly recommend. I would call him, Ray Dalio is like the Steve Jobs of the investment world.
Okay. All right. Well, thank you for the recommendation. And thank you so much for taking the time to talk with us today. I really, really enjoyed it.
Thank you, Andrew.